According to the Securities and Exchange Commission complaint, Luckin Coffee fabricated more than $300 million in retail sales. The complaint also says Luckin inflated expenses by more than $190 million and raised over $864 million from debt and equity investors during the fraud period. The SEC said the false transactions ran through 3 separate purchasing schemes. Employees also created a fake operations database and altered accounting and bank records. Luckin agreed to a $180 million penalty in December 2020, yet that wasn't the end of the company. Luckin passed through enforcement and restructuring, satisfied the penalty obligation through restructuring-related offsets, and continued operating. Its story turns on 2 questions. How did invented coffee sales acquire an operating trail, and how did the company survive after that trail was exposed? The chronology in the SEC complaint begins at least as early as April 2019 and continues through January 2020. The complaint says Luckin used related parties to create false sales transactions through 3 purchasing schemes. These weren't 3 unrelated accounting errors. Each involved purchases presented as business activity. The alleged sales then entered Luckin's books and publicly disclosed financial statements. The complaint says the company intentionally and materially overstated reported revenue and expenses and materially understated its net loss during 2019. That combination changed the picture presented by the accounts. Revenue appeared higher, expenses also rose, and the reported loss appeared smaller than it otherwise would have been. The mechanics began with Luckin's digital coupons. In the first purchasing scheme described by the SEC complaint, Luckin employees arranged for individuals, including employees, their relatives, and their friends, to transfer money into personal WeChat Pay or Alipay accounts. Those accounts were then used to purchase Luckin coupons through the company's application. The complaint says the coupons were redeemed through fabricated customer orders. On the surface, the activity resembled the ordinary path of a digital sale. Money entered a payment account, a coupon was purchased, and an order appeared in the system. According to the complaint, the participants and orders were being used to fabricate sales. The first scheme showed the basic method. A transaction could look routine inside the application while the supposed retail demand behind it was false. The second scheme moved from individual accounts to purported corporate customers. According to the SEC complaint, Luckin employees fabricated coupon sales involving corporate purchasers connected to employees or related parties. The corporate accounts transferred funds through payment platforms to buy Luckin coupons. Those transactions were then recorded as sales. The change in purchaser gave the fabricated activity a different outward form, but the complaint still describes related parties creating false transactions. A corporate coupon order could sit beside genuine business purchases in the records and appear to represent another source of demand. The SEC's account therefore reaches beyond false entries made after a reporting period ended. It describes employees generating transactions that entered the company's systems as apparent commercial activity. The third purchasing scheme introduced purported third-party intermediaries. The SEC complaint says Luckin employees or related parties established or controlled shell companies. Luckin entered into sham coupon purchase arrangements with those entities, which were presented as buying coupons for resale to individual customers. The shell companies transferred funds to Luckin, and the supposed coupon transactions were recorded as retail sales. This gave the scheme another layer of paperwork and another category of buyer. The complaint's 3-part structure matters because the fabricated revenue didn't arrive through one repeated entry with the same label. It appeared through individuals, purported corporate customers, and third-party shell companies. Different purchasers produced different-looking transactions, while the SEC alleged that related parties stood behind all 3 purchasing schemes. The transaction records were only part of the operating trail described by the SEC. According to the complaint, certain Luckin employees attempted to conceal the fraud by inflating company expenses by more than $190 million. They also created a fake operations database and altered accounting and bank records to reflect the false sales. Each category addressed a different part of the record. The database supplied fabricated operational information. The accounting records carried the transactions into the books. The bank records were altered to correspond with the reported sales. Inflated costs and expenses accompanied the invented revenue. The complaint therefore describes a coordinated falsification of sales, operating data, expenses, accounting records, and banking records, all supporting financial statements that materially misstated the company's performance. The distortion was visible in the percentages reported to the market. According to the SEC complaint, Luckin overstated reported revenue by approximately 28% for the period ending June 30, 2019. For the period ending September 30, 2019, the overstatement was 45%. During those same periods, the complaint says Luckin materially understated its net loss. These weren't differences buried several decimal places deep in a filing. The complaint describes material changes to the central measures used to describe a growing business: revenue, expenses, and operating loss. The rising revenue overstatement also shows the scheme moving through successive reporting periods. By January 2020, Luckin's fraud period had stretched across much of the company's publicly reported 2019 performance. The SEC complaint says Luckin raised more than $864 million from debt and equity investors during the fraud period. That is the documented connection between the false reporting and the capital market chapter of the story. The fundraising occurred while the company's publicly disclosed financial statements contained the material misstatements described by the SEC. The complaint charged Luckin under federal anti-fraud provisions and also alleged violations of reporting, books and records, and internal control requirements. The corporate case addressed the accuracy of the company's disclosures and records. It did not adjudicate individual culpability. Keeping that boundary clear matters because the settlement concerned Luckin Coffee Incorporated as the defendant, while the complaint separately described conduct by certain employees, officers, directors, and related parties. The misconduct was discovered during the annual external audit of Luckin's financial statements. According to the SEC, the company then reported the matter to SEC staff and cooperated with them. It initiated an internal investigation, terminated certain personnel, and added internal accounting controls. This discovery sequence is important because the invented operations trail had reached the records examined during financial reporting. The external audit became the point where that trail stopped holding together. The SEC's account then moves from fabricated transactions to corrective corporate actions. Luckin's response didn't erase the sales, expenses, database, or altered records described in the complaint. It established the company's cooperation and remediation as the enforcement process moved toward a corporate resolution. On December 16, 2020, the SEC announced its settlement in Securities and Exchange Commission versus Luckin Coffee Incorporated. Without admitting or denying the allegations, Luckin agreed to permanent injunctions and a $180 million penalty, subject at that point to court approval. The SEC's announced settlement allowed the penalty to be offset by certain payments to security holders connected with Luckin's provisional liquidation proceeding in the Cayman Islands. The mechanism was built into the corporate resolution itself. The penalty remained a formal consequence of settling the charges, while qualifying distributions made through the restructuring process could count against that obligation. The settlement therefore connected the enforcement case to the restructuring that would determine how Luckin dealt with its creditors and security holders. Luckin's later company filings document the next stage. The restructuring scheme became effective, its restructuring conditions were satisfied or waived, and the restructuring effective date occurred on January 28, 2022. Luckin's 2025 annual filing states that the SEC penalty obligation was satisfied through restructuring-related offsets acknowledged by the SEC on February 3, 2022. The obligation was therefore resolved through the offset mechanism contemplated by the settlement and the completed restructuring process. This didn't convert the complaint's allegations into findings against particular individuals, and it didn't remove the corporate charges from the record. It meant that Luckin reached the other side of both proceedings with the corporate entity intact and the SEC penalty obligation satisfied. Luckin's survival is the final tension in the record. The SEC described a company whose reported growth rested partly on false coupon transactions, inflated expenses, a fake operations database, and altered accounting and bank records. The corporate settlement imposed injunctions and a penalty. The completed restructuring then supplied the offsets through which that penalty obligation was satisfied. The company continued operating rather than disappearing. That outcome doesn't soften the charged conduct, it makes the case more instructive. The invented sales failed, the public record preserved how the schemes worked, and the restructuring preserved the business that had reported them. Luckin Coffee survived its fabricated growth, but it survived alongside a permanent documentary account of how that growth was manufactured.